Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at Duolingo Incorporated, ticker DUOL. This one, I ran the numbers a few days ago, wasn't really liking it, wasn't really thinking about posting it. I mean, I did see that Joseph Carlson had put a video out, watched a little bit. I think that he was a little crazy, just like a lot of people in the comments said. I don't see what he sees in it. I used to watch his channel. I stopped watching probably about a year ago because he just kept talking about the same stocks and was good at covering news, but nothing about the actual companies that he was owning. And a lot of it, I feel like he's just kind of lucked into where growth caught up to the market. Here, I'm looking for value stocks, so something that is starting underneath the market price. I'm actually considering watching some more financial YouTubers and graphing the results of their portfolios to see who is actually the best on YouTube. So if you guys have any ideas for who you want to see as a part of that, let me know. And I'd have to figure out how to work through everything, give everyone the same cost basis. But back to Duolingo, I mean, even the price targets from analysts are a little extreme here, because this is what analysts are saying that shares will be worth within the next 12 months. Well, you see Barron's is saying 410 and D.A. Davidson is saying 600. So there's a massive range here. A lot of it is about AI, strong growth, becoming one of the major players in online education, with them now doing music and chess and everything else. But I've been a Duolingo user for years. My streak on Duolingo for Spanish is 1,100 days. And I'm on the free version because just about every week they let me do a free upgrade to premium for a little bit, and I cancel it before they charge me. And it's not an upgrade at all, really. I can just go back and master concepts for free rather than having to pay gems for it, but I have so many gems that it doesn't really matter, and I have unlimited hearts. So I feel like your general user, it's not worth having to pay for unless they change the operation of the app. I don't know who's paying for it. Apparently a lot of people, but we'll get into the numbers and see. I'm surprised. I'll say that. Because I'm coming up with a fair value of $324. It's currently trading for $340. And part of why I'm actually recording a video is it had a massive rally. When I had ran the numbers, it was over $400. And now in the last month, it's down 8%. In the last week, it's down almost 3.5%. I mean, today alone, it was down 8%. So it's actually approaching what I have for the fair value. Discounted cash flow is 300. So if this drops below 300, I personally would consider buying it for a growth stock. I mean, the thesis here is pretty reasonable, and it's coming up with average annual returns of 27%, which is one of the highest that we've seen. Now, that's assuming analyst projections for revenue and earnings are correct. And with the price targets that they have set, I feel like they're pretty dang bullish on those. But cash flows are strong, usually 18.66. This last year came in at 35.29. ROE is good. Oh, well, yeah, ROE is pretty good at 10.74%. Debt to equity is below 1 at 0.58, so the balance sheet's fine. ROI is negative 3.28. ROA is 6.81, so those both could use a bit of work, but ROA is not awful. That's return on investments and return on assets, by the way. Gross margins, super strong, 72.73. On average, just shy of 73. So they were down a little bit this year, but net margins were up. On average, they've been losing money, and they're finally making money now, 11.84%. So the PE ratio is currently 51. Very high, but with the average returns of 27%, well, if you assume a 15 is equivalent to 8%, that you'd be coming up with 50.8 for a reasonable PE, and it's at 51. So For a growth stock, I mean, the PE honestly is not too bad. But the earnings growth rate is 19.6%, which gives you a price to earnings growth of 2.62. And we do like to see that closer to 1. So there's a lot baked in to that PE. And the divergence between the value and the PEG likely is coming from some of these other things. The balance sheet's improving. Margins we're expecting to improve. Other things that will help that may not flow through to earnings. Revenue-wise, coming up with 30 for our target. I mean, analysts are expecting 36 this year and almost 31 next year. You can see it's slowly declining, and that's likely just because you're getting a larger basis every year. I mean, if we look at the financials here, I mean, you can see the growth rate, but that's not going to continue for forever. At some point, they're going to hit market saturation and aren't going to be able to continue to add users at the rate that they're doing so currently. Share count, they issue a lot of shares, and a lot of it is just stock-based compensation. When we go to the retained income model, you see stock-based comp right here. Massive, and it's actually driving down the intrinsic value. The stock's only worth $74 according to. For a growth stock like this, it's definitely not as important of a measure. Your probably best bet is going to be discounted cash flows or something along those lines, which is coming up with about $300. So yeah, it's 10% overvalued, at least in my mind, but if it's growing 27% a year, you got a little bit of wiggle room there. $350 could be a reasonable price for kind of a moderate investor just wants to get their foot in the door, and dollar cost average down if it drops. But look at the range of this thing, $180 to $545. It seems like a hype stock, a meme stock. We'll just have to see how things play out over the years. But I'm expecting them to slow on that share count growth, partially because they now have more shares than they used to have, but also they're a profitable company, and so they can do better at paying their employees, not just doing so through shares. And they probably have a lot of the talent that they want if they're growing at this rate. Cash flows growing in line, maybe a bit above revenues. So 33% would take them to a cash flow yield of 39.6 over the next 5 years, which is probably pretty fair here, especially with the gross margins that we see out of them. Assets in the upper 20s. We see 25, 32, so 28 is fair, within range. Liabilities a bit higher, 47 to 52, so 49 smack dab in the middle there. They don't have a dividend. And margins, they're in a growth phase with their margins right now. With a gross margin of almost 73%, they should definitely be able to get the net margins up 20, at least 20 to 30, somewhere in there would be the ideal spot. And so 10% growth would take them to 19 in the next 5 years. And all of that together gets you 27% growth, which means if you're buying at today's price, you're outperforming the market by 1% in the next 3 years and by 90% in the next 5 years. So little 3x returns. This is just so massive that it compounds like crazy. Like at some point, revenue is going to slow. 43, 42, 36, 30. You know, if we take this down to 25, and then margins not growing as fast, they continue with their issuance of shares. Cash flows grow in line with the revenues. Assets and liabilities are okay. So I feel like a more reasonable, some would probably consider a bearish case, would be this 14%, in which case still in the next 5 years, you're outperforming the market by 3%. So the drop that it's seen recently has brought it back into play, where it's a value that I don't think that you're going to regret buying unless the company completely shifts off of its fundamentals and analyst projections. So I want to thank you guys for watching. Please like, enjoy the video, Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.